Okay. Okay, so today's topic is pancaking the unicorn, right? Yield farming on BSC. So I think the reason why I chose this topic, or perhaps I proposed this topic to Yunhan as well, is because while BSC Binance Smart Chain is more or less, it had its hype in the last few months, in the maybe during between March to May, but and now of course the main hype is with Polygon, right? Polygon Matic. But I still think that BSC has a lot of potential, and I think the next two slides will illustrate to all of you why I think there's a lot of potential with BSC. Right, so this is just my intro. Right, okay, so this was a screenshot that I took literally on 24th of June yesterday, right? And as you can see, the total TVL for Uniswap has dropped quite a lot, right? Of course, we're talking about in terms of USD. Let's not look at ETH or BTC because that one has an impermanent element to it, right? There's an element of another currency. If you look at it in terms of just USD, it's dropped quite a lot. And as of yesterday, it's about 5.22 billion USD. Whereas for PancakeSwap, the TVL has risen to about 9.24 billion. Now, I mean, a lot of people will debate on how these statistics are calculated. But even if we take into account certain discrepancies, you can see that right now PancakeSwap has actually overtaken Uniswap as the most has the swap with the most amount of TVL, right? And this is largely due to the sheer amount of forks from PancakeSwap into so many other farms and pools out there, so many other DEXs, right? And that's what we're going to talk about today, right? Yield farming is a general concept, but one of the most popular methods to do yield farming is to provide liquidity. And the liquidity is most often than not provided to a swap or to a decentralized exchange. Okay, so I'm just brief, sort of a brief comparison between DeFi concepts and traditional markets. I think most of you here are already experts on that, so I'm just gonna talk about it very quickly. I would like to point your attention to number 3 and number 4, yield farming and liquidity mining. Right, actually these two are pretty much synonymous. It's pretty much the same, but because of the fact that crypto is a very new space, the taxonomy and the vocabulary has not been fixated yet. So different people use different words in different manner, right? But whether it's number 3 or number 4, whether it's interest rates, dividends, or free NTUC vouchers, you can see there's an element of passive income. In other words, it's basically getting an additional source of income when you place certain amount of your crypto resources with specific platforms, right? I think that's the general concept. Number 1, number 2, I think these two you guys are very familiar. 2 has been there since 3 to 4 years ago, right? 1 has risen up for the past year. 5, 6, and 7. Number 5, lending platforms. This has been a hype when Uniswap first launched, right? Platforms like Compound, right? When you lend your liquidity for other people to take a loan, and then you earn interest rates based on that, right? So you are the loan provider, or you can be the one that's doing the loan, which is what we call a flash loan, right? So these are concepts that reason up together with Uniswap. And then Wrap Bitcoin is basically Forex. Why do I compare Wrap Bitcoin to Forex? Because if you know, Wrap Bitcoin is basically Bitcoin that exists on another chain. So the Bitcoin that we know exists on the Bitcoin chain, right? Wrap Bitcoin exists on perhaps Binance Smart Chain or even the Ethereum chain. So it's Bitcoin in that version. It's a bit similar to how the Brunei dollar is pegged to our Singapore dollar, right? Singapore dollar is $1 in Singapore, but it's also $1 in Brunei. So it's a bit like Forex, a bit like a pegged currency, all right? The idea of wrapping your crypto. Okay. Prediction markets, that's where I love prediction markets. That's why most of my projects, Metasphere and Auction, both revolve around prediction markets, because I see prediction markets category and products being the fastest bridge to your traditional markets, right? It's the easiest bridge between traditional markets and crypto finance to me, right? Because I think if I'm a old school banker, you want me to do yield farming, lending, flash loan, I think it's a little bit hard for the banker to accept all these things. But if you tell him it's still options trading, like you guys Bybit, right? It's still futures trading, but just in the crypto sense, chances are he will at least take a look, right? So that's why I love prediction markets. Okay, so when we talk about yield farming, it's basically using whatever money you have to grow it. You grow that money, right? And in this case, simply put, you are growing your crypto resources. Okay. But one thing to take note is that the money that you grow is not in the form of stable coins. So most often than not, when you do yield farming, you don't really get your rewards in stable coins. If you do, like for example, if you participate in, I don't know, Binance's flexible savings plan, all those things, right? That's not really yield farming. That's just a, if you ask me, that's just a fixed deposit program. All right. So what exactly is yield farming, right? So like I said, yield farming is very similar to liquidity mining. Now, whether it's yield farming or liquidity mining, the main concept here is very, very simple. You are just providing liquidity, right? You're just providing liquidity. Now, depending on the swap that you provide liquidity to, okay, you will get different tokens. Later on, I will demonstrate what I mean by that. And I think with a demonstration, you guys will be clearer if you guys are not already clear. All right. So that is one context of yield farming or liquidity mining, right? The word liquidity mining basically means that you use liquidity as a way to mine for more resources. So it's the same, right? You provide liquidity so that you can get more resources in return, right? Now, but sometimes certain traders or certain influencers, especially influencers, right? They like to use yield farming as a general word, like a general umbrella term to refer to all kinds of ways to make money using money, right? So for example, they call lending and borrowing platforms yield farming as well. That means as long as I become a, either I borrow money from compound or I provide liquidity from compound, I'm going to consider that yield farming as well. So it depends on how you use the term, but in general, it refers to the act of providing liquidity and getting more resources in return, right? That's the easiest way and the most clear-cut way to understand yield farming, liquidity mining. Now, however, while yield farming and liquidity mining has minimal differences, yield farming and staking is very different. All right. So again, we need to understand the difference between the two terms, right? Because we cannot use these terms loosely or interchangeably. If not, people get confused about what you're talking about. Okay, and I foresee this kind of communication problems rising up in the future, right? Especially when people are still not very clear what the two different words mean. Now, yield farming usually involves two currencies, right? Later I'll explain to you what that means. It usually involves two currencies. Of course, you can provide liquidity in the form of just one currency. You can, right? But it is usually two, okay? Now, staking usually involves just one currency, okay? So here's the first difference. The second difference is that the agenda between staking and yield farming is completely different, right? The way you operate yield farming and the way you operate staking is also different. So when we talk about staking, it's actually a security process. It's not a process for you to make money I mean, that's not the main objective. That is a objective, that is a spin-off objective. But the main objective of staking is to secure the proof of stake blockchain. Now, of course, this is not a blockchain class, so I'm not going to go into the tech, but I'm just going to cover it in simplicity. When we talk about proof of stake, it's quite simple, right? Basically, if you want to become one of the nodes, NODES, if you want to become one of the nodes for a proof of stake blockchain, what you need to do is you need to put down or put on the table some of your crypto. For example, if the proof of stake blockchain I'm referring to is Ethereum blockchain, right? That means you need to put down some Ether. Now, why do you need to put down some Ether? You can look at this as a character guarantee. All right, what does that? What do I mean by that? It means that when you put this Ether on the table, if your character is I would say if your character is not upright, which means you try to include fraudulent transactions onto the Ethereum blockchain, then this amount of Ether which you put on the table will be confiscated, meaning that it will be gone. All right. So what it means is that when you engage in the proof of stake blockchain, or when you do staking, you are actually putting down a form of character guarantee. You're actually putting down some form of a collateral, right? To make sure that you don't do the wrong thing. You do not include or attempt to double spend, attempt to include fraudulent transactions onto the Ethereum blockchain. So the whole motive behind staking is to make sure that nobody misbehaves, is to make sure that nobody will behave out of line. That is actually the main motive behind staking. The reason why you get rewards with staking is because people need to be incentivized to become a node. People need to be incentivized to become an accountant for the Ethereum blockchain with proof of stake, right? So they need to offer the rewards so that you at least buy the Ether, and then you at least want to grow your Ether, you want to become an accountant. So it's like a salary. It's like a salary. That's all it is. Staking is basically getting a salary and at the same time putting down a collateral to ensure that you yourself will not behave out of line. Now, yield farming has none of that. Yield farming is not so noble. All right. Okay, I don't know whether I used the right word there, but yield farming is not about ensuring that nobody misbehaves or whatever. No, it's just about you, for example, you lending the bank money so that they can, through fractional reserve banking, they can produce more money, which is what we call a PPP, a private placement program. A PPP is basically where the ultra high net worth they are being approached to lend the bank money so that with that money, with the debt that they incur, they can create more debt. Means they use your money so that they can print even more money. This is the biggest problem of fractional reserve banking. This is the biggest problem of the traditional banking world, right? And that's why we are all here, right? That's why crypto rose as a result. One of the many reasons. So yield farming is similar, right? You are lending liquidity to swaps so that when people want to exchange native tokens for stable coins or stable coins for native tokens, there is always a pool for them to tap on. If I want to buy, there's a buyer. If I want to sell, there's a seller. That's all. In other words, the entire swap depends on an automated market maker. And the automated market maker depends on liquidity. That's all, right? So you're just facilitating a process and getting rewarded for it in the process. So when we talk about providing liquidity, right? There are a few ways, and I think I already highlighted some of those ways. The first way is to really provide liquidity to a swap in the form of LP tokens. LP stands for liquidity pool, right? Now, this is the part where a lot of people always get confused. Now, there's pools and there's farms, which I will show you later on the swap, okay? But when you go into the farm, you're using LP tokens. When you go into the pool, you don't need LP tokens. So that's why I think the taxonomy in crypto can be improved. It's a bit confusing, which I will demonstrate to you later why. Okay, but to put it simply across to you, when we go into a swap, we need LP tokens. Because a smart contract can only interact with one token in any single transaction. That's why we always need to produce or mint LP tokens so that we can provide liquidity to a farm. We cannot just provide liquidity by putting two currencies in there. It doesn't work that way. The two currencies need to be fused to become an LP token, and then this token can be inserted into the farm. Because a smart contract, normally they can only interact with one token in any single transaction. That's the reason why we need to fuse two currencies to produce LP tokens. Right? Later I'll explain it. Later when I demonstrate, you guys will be more clear. All right? If you guys are not already clear. Now the second one is lending or borrowing platforms. This refers to an example of a compound, right? Whereby you lend liquidity so that they in turn can loan money to people, right? And then they can in turn allow people to perform flash loans, right? There is this this website called Fur Combo, I think, which helps you to create a flash loan, right? But I'm not going to cover that because that's not the context of today's presentation. Now, before I do the demonstration, it's important for us to understand a few more terms, right? Before we get to the action. The two terms that I want to actually expound on here. The number one term, the first term, is APR, annual percentage rate. Actually, these are banking terms. Although I put there yield farming, yield farm key terms, but actually these are all banking terms. These are all terms that you go to any banker, they can explain to you as well. So these are not crypto terms. These are terms that existed in the financial world long ago. All right. APR refers to annual percentage rate. So basically, both APR and APY refers to the ROI that you will get on the capital that you invest as liquidity to all the different swaps and DEXs. The only difference between APR and APY is one is compounded, one is not. Compounded means you always need to take the returns that you get and put it back. Take the returns that you got and put it back. Okay, so some farms are auto compounding, meaning that whatever you get, they will help you put it back automatically. Some farms are manual compounding, means that you yourself, you need to harvest the returns and put it back yourself. Okay, so a lot of the farms will be a bit cunning in the sense that they always make the figure of APY a huge figure on the website, and then they make the APR figure very small. Later, I'll show an example. But don't be fooled, okay? If you really want to, if you are the type to cash out every single month, you farm cash out to stable coins, your returns are based on APR, not APY, okay? But if you're diamond hands or platinum hands, right? You are the kind that I'm gonna hodl crypto for 10 years. Okay, maybe you can look at APY. All right, so but I doubt even myself, who is so involved in crypto, I'm not platinum hands lah. So very few platinum hands out there. All right, so these are the things that you need to take note of. Okay, so just now I talked about the concept of a LP token, which is a liquidity pool token. So in order to add liquidity to a DEX, right, the first thing that you need to do is you need to create or mint LP tokens. All right. Now, after you mint these LP tokens, then you can start to provide liquidity to a farm or a DEX, because that farm or that DEX's smart contract can only interact with one currency at any time. That's the reason why this minting process needs to happen. That's from the technical aspect. If they do not interact with that one currency, they cannot derive one result, which is your pool share. What is your pool share? So basically, the rewards are very simple. Every single farm, every single pool, they have a fixed amount of rewards per block, right? Now, the more people that are in the farm, the less each person will get as part of the rewards. That's the first factor. The second factor is the more LP tokens you inserted the larger the share of the rewards you will get. In other words, there's a shareholder concept here. So if out of 100 LP tokens, let's not talk about USD value, that will confuse you. Let's talk about just number of tokens. If there are 100 LP tokens and you hold 50, that means that you will take 50% of the block reward for the swapping fees and all that, right? Of the swap and of the DEX. Okay. But if let's say more people came in from 100 maximum LP tokens in the farm or in the pool, it expanded to 200. Then obviously whatever you were getting will now be slashed by half. So it changes. It's a dynamic figure. It's not a static figure. Okay. Another thing that you need to take note of when we talk about APR or APY is that it's measured in the native tokens terms. It's not measured in terms of the USD value. So if the token price goes up or down, the APR will change together with it. That's number one. Number two is if the token price goes up and down, which is what we call impermanent loss or impermanent gain, okay, your portfolio will also be affected. So I will cover more about this in the following slides. Okay, so this is basically the process of creating an LP token, right? So this is the math, right? I don't think you guys need to know the math, but this is on a good to know basis. Okay, you don't need to know this to be able to calculate. You don't need to know this in order to be able to become a liquidity provider. This is just good to know, right? Okay, so these are some resources. I think I'll come back to this later, but these are the different links that you can take note of, right? If you want to find yield farms on Binance Smart Chain, right? Then these two links, they are links for you to find the price of the token, because a lot of the newer tokens, especially those belonging to swaps, they are not listed on centralized exchanges. So you need to go to this kind of websites like DEX or dex.guru to find the price chart of the token. It's important to know the price of the token as well, right? So there are two risks when it comes to yield farming. The biggest risk is the main risk, not the biggest risk. The main risk is impermanent loss. So let's say you want to provide liquidity to a farm. You have to buy the native token of the swap, and you have to pay it with either BNB or BUSD. Now, this is what I'm talking about now is in the context of the Binance Smart Chain. For anything to happen on the Binance Smart Chain, you will definitely need BNB. That is a given. That is for sure. But when you provide liquidity, you can either combine the native currency with BNB to become LP tokens, or you can combine the native currency with BUSD to become LP tokens. If you want things to be safer, then you combine it with BUSD, because at least in that sense, you are only suffering from one side of impermanent loss or gain, meaning that your only impermanent loss risk will come from the native currency of the swap, because on the other side is BUSD, which is a stable coin, right? So if you combine BUSD with a native currency, then your impermanent loss will only be for your harvested currency, okay? But at the same time, do remember that when you pump liquidity to a swap or to a DEX, you will need to buy the native currency as well. So in other words, you are holding onto native currency when you're farming. So over there, if there's an impermanent loss, yes, at that portion, your portfolio value will also go down. It's like that. It's just like that. Okay. So this is the main risk. But the biggest risk, this is a market risk. This is a market risk. It's something that probably the developers can't really control, except if they burn tokens, but that has limited effect. Now, what can be controlled or what can be avoided is a rug pull or a flash loan attack. So recently, Barney suffered a flash loan attack. So what does that mean? It means that people what they do is they borrow. If let's say the farm or the swap or the DEX has a lending function, a loan function, then what people can do is that they can lend massive amounts of the native currency and then dump it on the open market. That's why Barney went from $450 all the way to, I don't know, like $3 within a few seconds, because that is a flash loan attack. Same thing happened to Iron Finance. In fact, I got it, right? My Titan went from $60 all the way to 6 cents. So yeah, sucks to be me, right? Okay. So how do you avoid these sorts of risk? Later I'll talk more about how you avoid. There's a way to stay safe. Okay. These are two examples of flash loan attacks, right? Then these are two examples of a rug pull, meaning that it's outrightly criminal activity. They just close the whole website and run away with all the value locked in the swap and in the pool. Okay, anti-social finance, mercat finance. These two are rug pulls. This is old data, right? When by the time you're looking at this, people know they're rug pull already, right? But I'm just telling you some examples. Okay, so now I'm going to do a live demo of yield farming. Okay, oh, okay. Share content. Okay, you guys can, sorry, this is my first time using Webex, so let me try and orientate myself a bit. You guys can see my web browser, right? PentaSwap. You are sharing PowerPoint slide. People are viewing PowerPoint slide. Okay, share my meeting. You are sharing two applications. People are viewing two applications. Okay. Okay. All right. So this is PentaSwap, right? So now I'm going to demonstrate to you the process of actually farming, right? So the first thing you gotta do is you need to go to trade, click on exchange, all right? Then what you do is that, of course, you need to connect your wallet first, right? So what you do is, first of all, you need to buy some of the swap's native currency. So for example, let's say I buy using my BUSD, right? Right, so let's say I buy about, I don't know, $50, right? So the thing to note is that if you use $50 to buy the native currency, if let's say the total amount that you are willing to put into this farm is $100, you don't buy $100 worth of the native currency straight away. You start with half, so about $50. Because later you need to use the other $50, the other 50 USD to create the LP tokens. So always divide it by 2. Okay? All right, so I'm going to swap. So get the native currency first. Okay, so I'm going to close that. So I'm going to wait for my, okay, so I got the Penta already, right? The next thing I'm going to do is I'm going to click on liquidity. I'm going to click on add liquidity. Okay, so when you add liquidity, this is the part where you combine two currencies to become an LP token. So what you do is that you select the native currency. Okay, and then you select the quote currency. That means the one that you want to combine with Penta. For me, I'm going to use BUSD, right? So what you do is that you click max on Penta, then it will tell you the amount of BSD you need. So you can see that I need 49 here. So that's why I say whatever you want to put into the swap, remember to divide it by 2. Whatever BNB or BUSD you want to put into the swap, remember to divide it by 2 because you need one half to buy the native token and you need the other half to create the LP tokens, which will represent the liquidity that you are providing. So supply, so confirm supply. Okay, so transaction submitted. Now just wait. So once it goes through, you can see that the LP tokens are here, right? And then it doesn't show you your share of the percentage, right? So after you get the LP tokens, what you do is that you go back to farms. All right. And then you find the Penta to BUSD liquidity pool because these are the two currencies that you use to create the LP tokens. So go back there, click on plus, click on max, then just supply. Okay, so just wait for it to load. So it's done, right? It's added already. If you guys remember the figure here, it wasn't, it's less. Give me a moment. Okay, so before you put your liquidity into any other LP, you need to approve the contract first, meaning that you need to approve the interaction of the liquidity pool with your wallet. All right, that is what it means. Okay, so after you add successfully, all right, that is the process of actually doing yield farming, right? That's the process. So there's farms and there's pools. Okay, so if you notice for pools, you just have to put one currency. Penta staked, BUSD staked, right? So these are what we call pools. But the tokens that you supply to the farms are called LP tokens, liquidity pool tokens. So yeah, it can be a bit confusing. All right, but usually the pools, the APR will be much lower than farms. Okay, this is the way they incentivize you to put your BUSD or BNB into the swap, right? Because in that sense, you are forming both the buyer and the seller side of the equation. But if you only supply Penta, you are just forming the seller side of the equation, meaning that you are just adding one currency. It means that basically you only allow people to buy or sell Penta. The other side, you are not going to be helping. So that's why they always give higher APR for the farming side. Okay? Okay, so let me stop share. Then let me share it again. Yeah, so that was the live demo. Okay. That's how you do yield farming for most of the swaps and DEXs that are present in the market now. I think I saw a question that says, how do you know which are the good swaps, right? So that's what we are going to go into in the next section. These are the 8 tips, all right, that I can give you as a farmer, right? These are the best ways to determine whether a swap is going to be a rug pull or is it going to be legit. Number one, look for farms with total value lock of at least 10 million. Now, number one and number two is correlated. Whatever you see on the website cannot be used solely. You have to confirm that figure by checking against their BSC scan smart contract. meaning that you go onto BSC scan, you copy the contract address of every single pool. It's right there on the swap. Okay, just now on PancaSwap, within that box, if I click on details, it will take you to BSC scan. Okay, then do a few random sampling and make sure that when you add them together, the value is at least close to whatever TVL they display on the website. Because certain pools or certain swaps or certain dexes, what they do is that they can control the website layer. The website is still hosted on a central server. So they can easily display 100 million there if they want to. But on BSC scan, the liquidity there does not add up to 100 million. So this is the first warning sign. The third point there, study or confirm their auditors. So here's the thing that I want to tell all of you. Here's a little tip that I can teach you, right? I mean, unless you already know. Okay. So what I do, right, is that, for example, let's say I go to Merlin. Again, I need to share my screen. Okay, share content. Okay, so let's say I go to Merlin. This is one of the farms that I'm farming at. Now you see, now if I click on Certic, it pops up the entire Certic report, right? So now you know, okay, great. They are definitely audited by Certic. But here's the thing. What if they say they are about to be audited by Certic, but the report is not ready? So they are at the onboarding process, right? Now, how do you confirm this? A lot of the swaps and dexes, they like to make use of people's ignorance and lack of knowledge. So what you do, if they say they're about to be certified, audited by Certic, very simple. What you do is that you go to Certic itself. Okay, you go to Certic, go to their leaderboard. Usually, if you search Certic, this is the first thing. Now, you can just search their project name. If they are in the process of onboarding, I'm not sure which project is onboarding now. Okay, but let's say I search Merlin and they are onboarding. Over here, they will say Merlin Lab bracket onboarding. That's how you know that they have really applied to be audited by Certic. Because anybody can put their logo on their website and say I'm about to be audited by Certic. Anybody can, right? And we all know any of these swaps, the developers are anonymous. PancaSwap, Evo DeFi, all the bigger swaps, even with a few 100 million, the developers, the owners of the swaps are fully anonymous. This is something that you only see in crypto, whereby somebody managing a few 100 million can afford not to show their face. Okay, so you cannot judge by the person's face or what. These swaps and these dexes, they don't have such an element. It's not like auction or a proper project whereby the team is there. No such thing. If you go to PancaSwap, there is no tab that will let you see the faces of the developers. No such thing. So this is one of the ways you find out whether they are really serious about the project. If they applied to be audited by Certic, okay, good, because it's not cheap. Being audited by Certic is at least 30,000-40,000 at least, right? And you have to be voted. People have to vote you, then you will get priority auditing. If not, you're going to be pushed all the way to the back of the queue. Okay, so this is one way of how you find out whether they are really being audited. Okay, this is the easy way for Certic. But if they say they are being certified by Hacken or HE, then for those auditing firms, you have to email them and ask. Okay, most of the time, they are honest, because it's quite stupid to fake this, but you never know. You never know. Okay, so this is one way that I can teach you, right? All right. Now, number 4 is go into the Telegram chat. Now, when you go to the Telegram chat, look out for 2 things. Number 1, are they using bots to add people into the chat? So click on the, I'm not going to demo here. I think you guys know Telegram better than me. You click on the title, the group chat's name, and scroll down. If you see a lot of deleted accounts, it means that they have been using bots. Okay, because bots will over some time they will they cannot afford to name the bot, all right, in terms of server space, so it becomes a deleted account. Now, if you see a lot of deleted accounts, that means they have been adding people into the group via bots. Now, there's nothing wrong with that, to be honest. All right, a lot of projects do it anyways. But of course, compared to a group that has grown organically, is definitely inferior. Why? Because the group that has grown organically without the use of bots means that the developers, the admins, the moderators have been keeping in touch with the community. If not, people will not pull people into the group if they know that the group is dead, right? So that's number one. Number two is look at the chat. Make sure that it's always different people talking, not the same boozers or the same people talking all over again. Number three, look at how fast the developers respond. All right. So these are the four things. The part one. Part two, you want to engage with a swap with as many features as possible, meaning that it will be good if they have lottery, if they have games on, or if they have NFT. An example is Evo DeFi, EVODEFI. I'm not endorsing them or whatever, but the fact is the swap is quite vibrant in the sense that they have NFT games. They have like a battle arena for monsters. Now, why is it important? When you see so many features on the swaps, it's giving you a hint of two things. Number one is giving you a hint on the development proficiency of the developers. How good are they with coding? Number two, it also means that the price of the native currency is stronger. Why? Because when they have so many mechanisms, it means that they have a lot of features to lock in people's native tokens. So if a lottery, I have to stake my token to get a lottery ticket, right? If I buy the NFT, I have to use the native currency to buy, right? So these are all mechanisms to make sure that the native currency is always withdrawn from the circulating supply, which we all know will affect the token's price. So go for a swap with a lot of features. If you go to the swap and it only has like 4 features, then you can be very, very sure that there are not many mechanisms to reduce the circulating supply. Okay? Number 3, investigate token price and present liquidity. Now, this is where you go into DEX Guru, you go into DApp Radar, okay? And then you check the liquidity, right? Now, the token price can be $200 for all I care. But if there's only 20,000 or 40,000 in the pool, it means that your token, even if you want to sell it, is not going to be very liquid. So please make sure that you check these other things as well before you go into the swap. Because ultimately, although we use the word farming, but technically you are actually buying the native currency. So it's an investment as well. So do the duty that you will do as an investor if you were to invest into a new token. Number 4, avoid swaps or farms with a lending function, with a loan function like Bunny, okay, or Iron Finance, because these are farms and swaps that are susceptible to a flash loan attack. Okay, Panther, as far as I know, does not have a lending function. Evo DeFi, as far as I know, does not have a lending function. So these are just 2 examples, right? There are many other swaps out there without a loan function. So make sure that you know it. And then the other thing is this. Sometimes the loan function is not found on the swaps website. Sometimes they partner up with a lending or borrowing platform. Then they list their currency for loaning on that website. So make sure you do your homework. Don't just go to the website, scroll up and down and say, okay, they don't have means they don't have. No, Google the farm, Google the swap. Make sure that they did not partner a lending or borrowing platform. Okay? So these are the tips and tricks that I give you. And these are tips and tricks that I got burned before already. All right, I got burned at least by 10K before, to be honest with you guys, right? Going to all kinds of swaps, take my money to experiment lah, basically. Okay, so these are tips and tricks that I can give you that you can use to find the best swaps out there. Okay, so the latest trend is matic farming. So this is a link that you can use. Actually, if you notice, the word vfat.tools always come out because this is like a directory function. The moment you put this URL link in, you can see the whole list of farms and swaps. But please, again, do your own research. This is a directory. It does not filter whether the projects are good or bad or shit. It doesn't. So it's just a full directory, right? Okay. Yeah, so that's it. I think next is the Kahoot, right? Maybe let me see if there are any questions. So maybe it's why Panther swap? No, it's just an example. It's just an example because I wanted to top up my investment into Panther swap, so I might as well use it as an example, right? So that's why Panther swap. I'm not endorsing them, by the way, but I think I already highlighted some reasons why I chose them. Can try.